I'm John. Welcome to Kennedy Analytical. And currently, what we're looking at is what I call Nigerian's liquidity fault lines, structural drivers, cyclical shocks, and monetary stability. So, is an integrated analysis mapping structural and cyclical liquidity drivers in the Nigerian banking system against CBN monetary policy rate decisions, headline CPI inflation, and USGN exchange rate volatility from 2010 to 2026. It also examines how oil dependency, fiscal deficit monetization, CRR, policy activism, and election cycle spending pause have collectively shaped liquidity overhangs and monitoring stability. So we'll be starting off with the headlines, the top lines numbers, and one of them is the CBN monetary policy rate, which is the MPR, currently sitting at 26.5% as of June 2026. And that number needs a bit of context. And the context is the fact that in 2010, the MPR was 6%, and that is 2050 basis point increase across the cycle. And also, it's worthy to note the fact that no peer central bank in Africa has executed a tightening cycle of that magnitude in that time frame. And to put it plainly, the cost of money in Nigeria has more than quadrupled in the last 16 years. So the second thing also to look at is the headline. If headline CPI currently sitting at 15.7% as of April 2026. And also it needs a bit of context. And the context is the fact that we peaked at 34.8% in January 2025. And it could be seen as the highest inflation really Nigeria has seen in decades. And the fact that we are now 15.7% represent 11 consecutive months of this disinflation, which is real progress. And but 15.7% is not price stability; it is deceleration, not normalization. So also we're looking at the naira dollar exchange rate, which is currently sitting at 1,361. The starting point in 2010 was approximately 150 naira to the dollar. The all-time peak was 1,717 naira per dollar in November 2024. The partial recovery to 1,361 reflects CBN reserve management, improved oil earnings, and the lag effect of tight monetary policy. But anyone who trades this pair knows the stability is fragile and highly sensitive to crude price movement. Also, the last but not the least is the cash reserve ratio, the CRR, for the deposit money banks, currently sits at 45%. And this is not a normal number globally. The South African operate at 2.5%, Kenya at 4.25%, the Ghana are currently 20%, which was reviewed as of June 4th, 2026, and Egypt at 16%, Nigeria at 45% sit in a category of its own. And that number is not just a monetary policy statistics, it is the single most consequential factor determining how much of every naira deposited in the Nigerian bank can actually be lent out, invested, or deployed. So we're actually going to return on this. So let's move into the analytical framework. Let's move into the dashboard. And it's also want to know that the dashboard is built around a distinction that I think is essential for understanding Nigerian monetary history. The distinction between the structural and the cyclical drivers of liquidity. So we're actually going to look at the structural drivers, which are without wasting much time. We're going to move into the structural drivers. So the structural drivers are systemic. They're embedded in the Nigerian's economic architecture and reproduce liquidity, volatility across cycles, regardless of who governs or what monetary policy prescribes. So they are the underlying bedrock on which cyclical shocks are amplified. So structural driver one is the oil revenue dependency and the FAAC volatility. So the FAAC, which is the Federal Account Allocation Committee, is the mechanism through which oil revenue is distributed from the federal pool to federal, state, and local government tiers. When oil prices rise, when oil prices are high, the FAAC disburses are large, and large volumes of naira flow into the banking system. When crude prices fall, those flows collapse. So between 2010 and 2014, when Brent crude was consistently above $100 per barrel, the FASC inflows were so large that excess banking system liquidity was a persistent CBN management concern. So the CBN was constantly issuing OMO bills, open market operation bills, to mop up what the physical side was injecting. Then in 2015 and 2016, Brent fell below $40 per barrel, and the FAC disbursement dropped by roughly 40%. And what has been a liquidity excess became a liquidity squeeze among almost overnight. So banks saw performing loans surge, Nigerian enter recession. This is structural dependency in action. So oil still account for approximately 85 to 90% of Nigerian foreign exchange earnings and 50 to 60% of federal revenue. Until that changes, the FAC will remain the primary liquidity faucet, and each own each one of character will continue to make monetary policy management extraordinarily difficult. So the structural driver too is the fiscal deficit monetization through the CBN's ways and means facility. So here we are looking at the Nigerian persistent fiscal deficit averaging within the range of 3 to 6% of GDP annually from 2015 to 2024, and it has been partly financed through the CBN ways and means advances to the FGN, Federal Government of Nigeria. And these are direct monetary financing, monetary creation that bypasses the bond market and inflate the monetary base. So by 2022, cumulative CBN ways and means advance had reached 222.7 trillion naira, a significant portion of broad money supply, and the federal government securitized 22.7 trillion of these in 2023 as 40-year bond at 9%. But the inflationary impulse had already been transmitted, structural fiscal imbalance driven by low non-oil revenue and enormous subsidy obligation, which ensure that this channel remains active. So liquidity impact intensity here is quite high, very, very high. The same thing with the oil dependency and FAAC volatility. So on the supply side, the third structural driver is the supply side infrastructure deficit. So this particular one operates differently from the others, and it does not inject or drain liquidity directly. What it does is anchor inflation at a structurally elevated floor. So also the fact that Nigeria had a population of over 220 million people with an average power availability that has historically been below 5,000 megawatts. So the consequences for banks and corporate is a dramatically inflated cost structure. Every business running on generators, every bank branch running on diesel, every logistics operation absorbing impassable road costs. This supply deficit mean that even when demand side monetary condition tighten, inflation has a floor because supply side costs are structurally high. This compressing the CBN room to cut rates, and it means that even when this inflation cycle is running as it is now, the CBN cannot ease aggressively because the underlying supply side drivers or prices have not been resolved. So looking at the impact intensity here is medium to high. So on the FX regime architecture and multiple rates system, which is the fourth structural driver. So for the most of the period from 2010 to 2023, is worthy to note that Nigeria maintained multiple official foreign exchange windows simultaneously. So we have the NIFS rate, the NAFES rate, the I&E window, the BDC market, each representing a different access point for dollar at a different effective rate. So this architecture created systematic arbitrage opportunities, and banks and corporates who buy dollars cheaply at official window and sell at the primary market, generating naira liquidity synthetically through FX spread capture. So when the CBN periodically clamped down restricted BDC allocations, imposing import restriction lists, blocking capital repatriation, those arbitrage flows reversed violently. So the most dramatic example is June 2023 when the Tinubu administration unified the FX windows. So, in a single policy action, the official exchange rate moved from approximately 465 naira per dollar to 800 naira per dollar. Banks with unhedged FX position, importers with dollar denominated obligation, and any business model built on the arbitrage spread face immediate and severe balance sheet stress. That was a structural regime change, not a cyclical shock, and it rippled through the system for the next 12 to 18 months. So yeah, so now we'll be moving to the cyclical driver. So yeah, the cyclical driver one is the electoral spending cycle. So yeah, Nigeria operates on a 4-year democratic election cycle. So we have this presidential elections fell in 2011, 2015, 2019, and 2023. And in every one of those years, the pattern is consistent. The government spending accelerates in the quarters before and during the election. The FAAC releases often supplemented or from loaded and informal cash flows, vote related spending, party financing, campaign logistics inject large naira volumes into circulation. So the 2022 to 2023 cycle was especially dramatic because it was compounded by the naira redesigns exercise. So the CBN attempt to swap old naira notes for new ones created a cash holding dynamic that caused currency in circulation to spike in the ways the system had never seen. Banks in 2022 and early 2023 were simultaneously managing election cycle excess liquidity and operation chaos of currency swap. So the cyclical pulse map in the dashboard shows the difference clearly. And in an election year, the liquidity index is elevated through Q1 and Q2 as campaign spending flows through. Then contrast sharply in Q3 and Q4 as the CBN moves to sterilize the excess. So looking at the second driver, which is the seasonal currency in circulation. So, see, currency in circulation is a bit strong seasonality. Also, we saw a spike in Q4 festive season, which is Christmas like New Year. The either victory variable month, academic year resumption, September, and harvest payment cycle, October to November. So these withdrawal creates transient but sharp bank liquidity squeezes, especially in the smaller regional slash microfinance banks. So the CBN respond with repo facilities and open market. They post demonetization, which happened in January 2023. The CIC pattern have been further distorted as physical cash trust issues persist, and mobiles like agent banking compensate only partially. So peak impact here is medium to high. So on the last, which is the CRR and the OMO policy adjustment, we'll also be looking at this in a while. So this is the most technical significant cyclical driver, and it is one that most directly shapes interbank conditions. So the CBN uses two instruments for short-term liquidity management, which is the cash reserve ratio and open market operation bills. So the CRR changes discrete shocks when the CBN raises CRR, it immediately freezes a larger fraction of every bank's naira deposit at the CBN, with zero return. So this is sterilization by fiat, and the OMO bills, on the other hand, are market based. So the CBN issued bill to drain liquidity and retires them at maturity. The problem is that large OMO maturities create their own liquidity pauses. When 500 billion, 1 trillion in OMO bills matures simultaneously, that cash floods the interbank market. The NIBOR, the Nigerian Interbank Offer Rate, drops sharply, and then as the CBN reissues bills to mock it up, mock, yeah, mop it back up, the NIBOR spikes again. So this volatility in NIBOR means that the interbank rate, which is supposed to be anchored by the MPR, moves in ways that are disconnected from the CBN policy signal. So that's it on the cyclical drivers. So we'll also be looking at the correlations and regime. Then after that, the liquidity heat map. So on the correlation and regime, here we have the various charts, but the chart of focus here is the CRR level versus the neighbor spread to MPR. So the scatter chart on the correlation tab shows clearly that there is a strong positive relationship between the level of CRR and the size of the neighbor spread above the MPR. And CRR, the more the market's rate overshoot the policy rate. So yeah, let's bring it together. Let's bring it all together on the timeline and correlation analysis. And the master timeline on the dashboard first tab overlays the MPR and the CPI from 2010 to 2026. The story tells in visual form is the fact that from 2010 to 2014, we could see that the CBN was tightening, and NPR moved from 6% to 13% because of 6% to 13% because of oil revenue, which were injecting large quantities of liquidity into the system, and inflation. So why not? Why it wasn't really catastrophic? It was also creeping upwards. So from 2015 to 2016, the oil crash forced a different problem. The CBN was simultaneously trying to defend the naira, manage a recession, and deal with collapsing FASC inflows. The MPI was cut to 11%, but the real monetary tightening came from FX rationing rather than the policy rate. So from 2017 to 2019, there was a partial stabilization. Then the COVID arrived in 2020, and the CBN cut the NPR to all-time low of 11.5%, while simultaneously raising the CRR from 22.5% to 27.5% at the same meeting. So, which is a contradictory signal that reflected genuine policy dilemma. They wanted to stimulate credit, but sterilize the fiscal stimulus cash injection coming from the government's COVID response packages. So the 2023 to 2024 period is the most dramatic stretch in the entire 16-year series. And the FX unification in June 2023, the removal of the fuel subsidy and the CC rate hike in 2024, while the MPR going from 18.75% in February 2024 to 27.5% by May 2025 happened simultaneously with the worst inflation reading in modern Nigerian monetary history, sitting at 4.8% in January 2025. The composite index chart on the correlation tab makes the magnitude of this visible. All four variables, the MPR, CPR, USD, and GN, and the CRR index to 2010 at base year converge on a simultaneous spike from 2023 onward that has no precedent in the prior 12 years of the series. So looking at the correlation table, which draws out the key relationship quantitatively, the strongest pairwise correlation in the data set is the USD NGN to CPI inflation at approximately positive 0.85 for the post-2015 period, which tells you that import-dependent inflation is the dominant transmission channel. So a bit about that is the fact that, like I rightly mentioned, the naira depreciates. When the naira depreciates, prices of imported goods, input and fuel goods, go up, and that feed directly into the CPI, which roughly a one to two quarter lag. And this is the nails of the Nigerian's monetary problem. Depreciation feeds inflation. Inflation forces rate hikes. Constrained credit slows growth. Slow growth reduce fiscal revenue, pressure the exchange rate, and the cycle repeat. So yeah, that's it. That is the full analytical walkthrough of this dashboard. What it is the Nigerian's banking system liquidity is not primarily a product of central bank decision. It is a product of the structural architecture of the economy, an economy built on a commodity that is volatile, managed through fiscal framework that is current and operating within an FX system that has historically generated more arbitrage than it has genuine price discovery. So the CBN tools, which is the MPR, CRR, OMO, are real and consequential, but they are a cyclical instrument trying to manage structural problems. Understanding that distinction is, I'll argue, the most important analytical takeaway from everything this dashboard maps. So yeah, thanks a lot for watching.